Is SHEL a buy now? Is it going to offer you constant dividends year on year with nice growth? Let's find out today in the episode. We're going to take a look at some historical data. We're going to take a look at the balance sheet, the cash versus total debt. We're going to take a look at their revenues, how they have progressed over the last 5 years, how they've affected that bottom line, their net income. Take a look at that dividend safety, understand it a bit more with some very important financial metrics. And as always, end the episode with that stock valuation model. Now, let's jump straight in. Year to date, SHEL is up 8.72%, heading towards that 52-week high, with a yield sitting at 3.53%. Now, when we take a look at their revenues, typically for companies, we like to see a moderate, steady growth of 3 to 7% year on year. We can see here in December 2018, SHEL reported $388 billion worth of revenue. And over the past 5 years, December 2022, they reported slightly lower at $381 billion. Now, not the greatest growth that we can see over here. In fact, it has decreased, and we can see from December 19 to 21, the decrease and the increase that took place, which you could argue due to COVID. People were using vehicles less, along with other needs for their goods and services. Now, when we take a look at their bottom line in terms of their net income during this period, we can see that in 2018, they reported a gain of 23.3 billion. And in 2022, just under double that net income at 42.3 billion. We can see here, maybe possibly relating to the COVID year, a loss of 22 billion. Now, we can see nice growth over the last 5 years, but I do typically like to look at least 5 to 10 years worth of data to get a good understanding of the business. Now, what's quite important with a company like SHEL is just to take a look at their cash versus their total debt position to ensure they are able to continually pay those debt payments, interest payments, and pay the dividends for the shareholders. Now, the cash and short-term investments in December 2018 was 26.7 billion, and in their latest quarterly report, just under double that at 42 billion. So they are holding a significant amount of cash. Now, how does that compare to their total debt? So we can see here their total debt in 2018 was 76.8 billion, and it in fact increased to 85.1 billion. So they do hold a significant amount of debt, and we can see this has increased over the last 5 years. Now, in terms of that dividend safety, it has a score of 45, which makes it borderline safe. Never great to see as a shareholder. Market cap at 203 billion. Now, in terms of some key metrics, they have only paid dividends for 2 years, the last 2 years, without a reduction. We'll get into that shortly. If you believe we are heading into a recession, well, in the last recession, they maintained their dividend. They didn't increase it, but they also didn't cut it. They also had negative 42.5% sales, which is quite significant and significantly below the average growth rate, which was also negative during the last recession. They did, however, in terms of their return, have negative 42%, which was only slightly better than the S&P 500's negative 55% return. Now, dividends, we love to see double-digit dividend increases, and we can see here in February 23, 15% increase. Now, whilst that does look good, when we look here, the last 5 years have been negative 11%, and the last 20 years negative 3%, which realistically, if you've been watching my episodes, you know that I will say a minimum of 4% increase is what you want in your dividends, salary, other income producing assets, as the US inflation rate is 4% over the last 40 years. So if you're getting less, you are losing your purchasing power and taking a pay cut. So this is very negative to see, a big red flag in my opinion that we have spotted at the beginning. They have, as mentioned, increased the dividend only over the last 2 years. As we can see here, there was a cut, and there was another cut here pre-2004. Now, dividend yield theory states that a company is undervalued when the current yield is sitting above the 5-year average, and in actual fact, we have the opposite here, which makes it seem, due to dividend yield theory, the company is overvalued. But as always, we never make our conclusions based on one model, and we will conclude at the end of the episode. Forward PE, when the forward PE ratio is below the 5-year average, it deems it to be undervalued. So this is a sign of undervaluation. As always, we don't look at any model in isolation because we would get lots of different answers. And Shell's PE ratio coming in below the sector PE comparison. For information purposes, did mention this earlier, it is at the 52-week high or heading towards there. But again, this does not mean it's overvalued. Likewise, it wouldn't be undervalued if it was at the 52-week low. Now, earnings payout versus free cash flow payout. If you've seen my episode, you know we only look at the free cash flow due to the fact that earnings payout is susceptible to manipulation by management through accounting. So therefore, for investors who do like this, however, I do like to look at a minimum of 60%. So, I mean, you can already see a lot of red flags here. There are a few years where, in fact, it is over 100%. However, looking at the more recent data, 36% in 2021, 19% in 2022. Likewise, with the free cash flow payout, a few years where there are some red flags. However, after 2017, it has come into a more acceptable range, with 2022 coming at 17%. So quite a lot of things at the moment to take into account. Now, earnings per share, again, we prefer to look at the free cash flow per share, but 2013, $3.10, 2022, $5.53. So it has increased. But again, this is why I like to look at 10 years data so you can get a better picture. We can see it has struggled to be higher than that 2014 figure for almost 10 years. 2023 is, however, expected to be lower than 2022. So do bear that in mind. Free cash flow, 7 cents in 2013, $6.24 in 2022, and 2023 expected to go lower at $3.93. So again, not the greatest. We do like to see upward trends, so do bear this in mind. Now, as mentioned, 3 to 7% is what we like to see. You could argue this is cyclical due to the fact that there are many negative years and then positive years and negative and so on. But realistically, looking at our total sales here, this isn't really what we want to see from a company. We're investing $451 billion worth of sales in 2013. 381 in 2022. So it is declining. So again, do bear that in mind. There are quite a few things here where I would say are red flag indicators. Shares outstanding. We love it when companies return excess cash to shareholders by doing share buybacks. In fact, Shell have pretty much done the opposite for a large part of the 10 years where they have issued shares diluting your ownership as a shareholder. However, from 2018, they have bought a little bit of shares year on year. So overall, from 6.29 to 7.41, it has still gone up over the last 10 years. Not great as a shareholder. Return on invested capital, do go check out my pinned YouTube video. It discusses my 7 golden dividend metrics I use to look at stocks. One of them is the ROIC, where I look for a minimum of 10%, as it means management are able to effectively allocate their capital. So really, there have only been a few years above 10%. 21, 9%, 2022, 22%. So it is positive, but at the same time, we would like to see some consistency with this figure. So again, something to bear in mind. Operating margin for all producers, we'd like to see around 12%. Other than 2022, it has been below that. So again, something else to consider. Free cash flow margins above 5%. Last few years, it has been over that, so not a massive worry, but there are a few years where it did slip below that. So again, there are quite a significant number of things to take into consideration, personally for me anyway, before investing in this company. Net debt to earnings before interest, tax, depreciation, amortization. For all producers, we like to see below 1.5. For the majority of that, it has been around that and below. So I would say personally, with the debt levels currently, it's not a big worry for me. 2022, it would take Shell 6.67 years to pay off all their debt and net of cash on hand, so that's positive to see. And this is essentially showing us that in 2022, 23% of the company's financing is from debt as opposed to equity. Now we jump in the stock valuation model. As always, if you are enjoying the content, do hit that like button, do hit that subscribe for continued content. If you want to grab a copy of the stock valuation model, do check the pinned comment and you can run your own stocks of portfolio through these to see what the intrinsic value would be. And if you do want to join us on Patreon, do again check the pinned link. Now, stock we have here for Graham's valuation, earnings per share 12.12. Now the growth of it as expected by analyst estimates is expected to decrease. And with our current yield on AAA corporate bonds sitting at 4.73, we have an intrinsic value of 45.10. Now again, this is quite significantly lower than the current trading price, but we can see here it is just at that 52-week low. Now, multiples valuation model, we're using companies in a similar sector and size. We have BP, CVX, and Exxon. Once we have the stock price and EPS, we get the P multiples, of which we multiply the average by the EPS of SHEL. This gives a multiples valuation of $81.41. So some nice upside to that current share price. Now, the dividend discount model, as we saw earlier, it is negative growth over the last 5-6 years. But however, I have expected around 6% moving forwards, purely based on the last 2 years and given the considerable cash amount that they hold. You could argue it could be higher. I think you could also probably argue it could be lower, but this is what I've gone with. Do grab yourself a copy of the stock valuation model if you want to play around with this yourself. This gives a DDM price of $55.12, in between that 52-week range, slightly lower than the current trading price. The discounted cash flow model, once we've inputted the free cash flows, we see the growth year on year. Average growth rate quite high at 587%. Analysts are estimating negative growth, and I've been a bit more conservative and made it slightly higher, so minus 10%. When we use our discount rate, we get the present value of these future free cash flows and terminal value. Add this with the cash, subtract the total debt, we arrive at our equity value. Once we divide by the shares outstanding, we get a DCF price of $93. So there is quite some nice upside on that model. Now, as always, do hit that like button if you are enjoying the content, and do subscribe for more content. The intrinsic value is essentially the average of the 4 models we have just gone through at $68.68. Now, typically for a strong company with a wide moat, nice data that we've just seen, nice strong financial metrics and forward-looking guidance, I would be looking for a margin of safety of 10%. SHEL, I would be looking for a higher margin of safety. But for those who would be looking for a margin of safety of 10%, your buy would effectively be around the current price at the moment, $60, $61. Now, if you're looking for a higher margin of safety like me, at probably around 20%, your acceptable buy price would be around $55. And we can take a look, and it's towards the lower end of that 52-week range. Now, Wall Street forecast the price over the next 12 months to hit around $68, so fairly in line with our intrinsic value. So a little bit of upside to that current share price. As always, let me know your thoughts in the comments. Are you looking to buy SHEL? Are you looking to sell? Or are you on the sidelines? And as always, have a great day and catch you on the next episode.